Good morning, ladies and gentlemen. It's a real pleasure to share some thoughts today with such a distinguished group of business leaders, even though the topic that I was assigned, getting Eurozone governance right, does not allow me to talk much about whiskey or champagne. Today, the macroeconomic and business environment remains challenging, but to quote Mario Draghi, the darkest clouds over the euro area have subsided. In my dual capacity as an industrialist and as chairman of the Eurozone, one of the Eurozone's largest bank insurance groups, I share this view. I am among those who see the glass as half full, or actually as more than half full, and the complicated election results in Italy do not change that view. Admittedly, the process that has been followed in addressing the Eurozone crisis has been messy. But the progress that has been made in aggregate is quite remarkable. The euro is here to stay, a fact which even those who only a year ago confidently predicted its imminent demise now grudgingly admit. At the same time, many countries are further ahead on the road to reform and fiscal consolidation than was thought possible. Yet, it is equally clear that there are absolutely no grounds for complacency. Much needs to be done to ensure a sustained stability of the Eurozone and a return to sustainable growth. In addressing the topic to hand, getting Eurozone governance right, let me start by looking at the roots of this crisis once more, before turning to the steps that have already been initiated and the further steps that need to be taken to improve the Eurozone governance. I will argue that further building on the institutional framework is necessary, but must go hand in hand with pragmatic economic policies to foster growth in Europe. The Eurozone crisis has many phases. It occurred when the epicenter of the global financial crisis shifted from the US to Europe. At its core lies a balance of payment crisis, reflected by large current account deficits, excessive debt accumulation by both public and private sector, and a loss of competitiveness in some countries. Ultimately, however, it is clear that at its very root also lies an institutional crisis. The shortcomings in the process of political integration allowed countries within the common currency to maintain unsound financial positions and impeded a faster correction of unsustainable growth models in some countries. This led to a buildup of macroeconomic imbalances, often heavily dependent on intra-Eurozone lending. The global financial crisis brought these major macroeconomic balances dramatically to the fore, and extreme risk aversion suddenly stopped financial flows between the member states. All of a sudden, the shortcomings of the monetary union became crystal clear. Its institutional framework was not prepared to deal with this challenge. The outcome was, as we all know, an ever-escalating crisis, reinforcing itself through the absolute disintegration of the European financial market. Clearly, the crisis demonstrated the incomplete character of the economic and monetary union. The existing government's tools failed. The Stability and Growth Pact was ill-equipped and inadequately enforced. No effective economic coordination or correction mechanism was in place, so that the building up of imbalances was left unattended, and the financial sector remained under national supervision. And thus, the pressing questions arose. What are the minimum conditions to ensure the full viability of the Eurozone over time? What does Europe really need? What surely is crucial in the monetary union is the role of a stabilizing central bank. Capitalizing on the credibility of the ECB established under Jean-Claude Trichet, his successor initiated bold action when needed. Its formal commitment late September to safeguard the financial stability of the euro was a necessary but not a sufficient condition for assuring the sustainability of the euro in the long run. By doing so, the ECB has, however, built a bridge towards stability, providing a window of opportunity for governments to address the fundamental challenges and complete the Eurozone's institutional architecture. This depends on three institutional pillars: a fiscal pillar with enforceable rules to restore fiscal capacity and debt sustainability, an economic pillar that fosters competitiveness, sustained growth and employment, and a financial pillar with a single supervisor reunifying the banking system. The future prosperity of Europe, its firms and citizens, hinges on the ability of the European leaders to complement the monetary union with these new pillars. On the fiscal front, important reforms were put in place both at the national and European level. As of September last year, a permanent European stability mechanism, the ESM, was established. It provides a solid safety net and mutualizes fiscal capacity in support of member states if needed, at least for smaller states. As such, the ESM is a first step toward a limited mutualization of debt. But one should not forget that real solutions to foster economic growth in Europe cannot come from ever more government debt. From that perspective, it is very encouraging that over the last 2 years, countries have renewed their commitment to fiscal reforms. At the center of this are the Fiscal Compact and the new European legislation such as the Six-Pack and the Two-Pack. The Fiscal Compact Treaty became effective since the start of this year, applying new, more enforceable rules to strengthen oversight of government budgets. Here in Ireland, it was adopted after a referendum that showed the willingness of the Irish people to stay in the euro and adhere to the principles of this strengthened governance, sending a strong and positive signal to the rest of the Eurozone and the world. I see now that the public finances are gradually improving, as is markets confident in government actions, and as we've seen, employment is slowly starting to recover. To further strengthen this confidence, fiscal consolidation not only needs to credibly contain public debt ratios, but also avoid a major short-term contraction of real economic activity. This calls for a differentiated approach to consolidation that, on top of the general debt and deficit rules defined in the Compact, allows to take into account current country-specific economic conditions. If growth unexpectedly deteriorates or a country-specific shock occurs, it should be given extra time to correct its excessive deficit in order to avoid the vicious spiral of negative growth and deteriorating public finances. The introduction of reform contracts, as proposed by EU President Van Rompuy, as a convergence and competitive instrument is a good idea, though not yet accepted by the European Council. Such country-specific contracts are conditional and imply only temporary fiscal support. By limiting the financial support in time, it is avoided that the Eurozone turns into a permanent transfer union, which we should avoid. Moreover, the contract targets structural reforms, and thus are growth enhancing. This brings me to my next point, the economic pillar. The crisis has indeed shown that not only government finances should be the focus of further integration, but also economic policy. Coordinated economic policies are essential to complement the monetary union. To this end, the Commission started the macroeconomic imbalances procedure, aiming to prevent build-up of new and enforce correction of existing imbalances. These are, amongst others, the large current account deficits and surpluses, excessive debt accumulation by the private sector, housing bubbles, and loss of competitiveness. Correcting these imbalances is a difficult and painful process, but it is essential for future and sustainable economic growth. Let me focus very briefly only on the key policy concern here, the restoration of competitiveness, because other speakers, such as Leif, will address it later. Europe's future prosperity clearly requires member countries to be competitive, meaning that their institutional and macroeconomic conditions should allow productive firms to thrive globally. To that, Ireland is a bright example of restoring competitiveness. Next to prices, costs and wages, there are also other considerations specifically for advanced economies. Europe's comparative advantages at a global level have to be its specialization in high-value products and innovative technologies. Being competitive in a broad sense is also taking full advantage of a well-educated labor force and innovation potential. A central challenge for policymakers is thus to set conditions that allow the skills and capabilities of the labor force, especially of the younger people, to be well developed and valuably employed by competitive firms or in the new enterprises that these young people will establish and develop. A flourishing, business-friendly environment should support entrepreneurs. And supplementary to that, there's a vital role for the banking sector. This brings me to the third pillar, the banking union, which should again integrate the European financial system and restore sustainable lending to the real economy. The decision to create such a union was perhaps the most important response to the euro crisis in 2012, and this for two reasons. First, the strong interconnectedness with banks and sovereigns in Europe, and second, the role of banks in financing the real economy and especially the many SMEs in Europe. Since the start of the crisis, the strong integration between banks and sovereigns has threatened to create a vicious spiral of deteriorating public finances and a financial sector balance sheet crisis. Combine this with the important intermediary role of the financial sector in Europe and the risk of a credit crunch pushing the real economy into severe recession became very real. But most banks have learned their hard lessons. Much more than many people think has in the meantime been done by European banks to improve their solidity. By increasing their core Tier 1 ratio capital by 25%, by already 190 billion euros of additional capital that has been created, and by reducing their risk-weighted assets by some 2%, major banks have improved their average core Tier 1 ratio from less than 9% in 2009 to 11.4% in the last quarter of 2012. My own institution, KBC, raised its core Tier 1 ratio from 9.2% to 12.5% in 3 years' time, despite repaying at the same time 4.2 billion euros in state aid, as well as heavy penalties and high interest costs over the same period. We did this by a combination of a capital increase, retention of earnings, reducing risk-weighted assets in investment banking, and divestment of non-core assets. In the same period, lending to private persons and businesses in our core countries actually grew by 3% year-on-year, defying conventional wisdom. More generally, investors' confidence in European banks strengthened in recent months, as witnessed by improved funding conditions and the recovery of bank share prices. The first results of regained trust in the banking system have also become visible more generally in lending rates to the real economy that started to realign. On top of regulatory measures and capital rules, institutional reforms towards the European Banking Union were necessary to counter the unraveling of the single financial market, disentangle banks from their sovereigns, and fix the credit channel to restart growth. Over the last 6 months, European leaders have decided on a single supervisor, and by doing so showed their capability to reach agreements on deepening the Eurozone. Also, this decision contributed to the return of trust in the banking systems. But it is imperative, as the Taoiseach said, that we now carry on, that we actually implement fully this single supervisor, and also to establish a fully fledged banking union. It is imperative to continue to match the integrated supervision with a single resolution mechanism, a credible fiscal backstop, and eventually a single deposit guarantee scheme. This again will involve greater solidarity and the sharing of sovereignty between member states, but it is indispensable if we want to really establish a level playing field between Eurozone banks and avoid the resurgence of the vicious cycle the next time a crisis hits. Let me now draw to a conclusion. Over the past 2 years, substantial steps have been taken by European politicians to address the institutional shortcomings that were at the heart of the euro crisis, including a new fiscal and economic framework, a permanent stability mechanism, and an area-wide banking supervisor. The country level, budgetary and structural economic reforms have been implemented, leading to first successes. In Ireland, for example, competitiveness has been restored. Economic growth is starting to improve. The structural deficit has been lowered significantly, and the full return to the financial markets is underway. European banks, as I have argued, have made significant progress in building strong capital buffers and regained credibility through recent reforms. These steps, together with the ECB's commitment to safeguard the euro, have stabilized the eurozone and reversed the looming disintegration. All this constitutes a necessary precondition for the recovery of sustainable economic growth. Essential to all this was the clear willingness of European leaders to continue the political project, a willingness which has often been underestimated by commentators and financial markets. Today, new EU member states such as Poland again consider joining the euro in the near future. I have the personal belief that ultimately membership of the eurozone and membership of the European Union will have to converge and will converge. This obviously would require a fundamental choice in some countries, especially by our British friends. The British pro-market instincts have often in the past provided a very welcome counterweight in the EU against more statist tendencies. Therefore, a continued British membership is highly desirable. But this will require acceptance by the British people that the European Union is more than a European Free Trade Association. Those in Britain who are tempted by the vision of becoming some sort of a European Singapore outside of the EU should, in my mind, be aware of the danger of ending up as a greater Monte Carlo, but then one surrounded by an industrial wasteland. Whilst the agenda of European integration should not be driven by the internal political constraints in a single member state, I personally feel that the debate about the shape and the efficiency of the European Union is one that we should not now avoid. It has often been repeated that the European Union lacks political legitimacy. This view seems to forget that there is actually a European Parliament, which is very powerful in a number of areas, including the approval of the budget and the nomination of commissioners. Therefore, it seems to me that the run-up to the European elections in 2014 should be an excellent time to raise awareness of this democratic tool. It should be the moment for them, for the major pan-European parties to articulate their visions and submit them to the European people. Whatever the outcome of these debates and elections, the European Union will not in the foreseeable future become a federal state like the United States. Instead, Europe will continue to grow a model of its own, seeking a right balance between a certain mutualization of risks, increased responsibility of individual member states, and some further sharing of budgetary sovereignty on top of ensuring a strong single market. To find this model, to achieve a stronger and better Europe, is the urgent mandate of this generation of leaders. The sustained prosperity and the continued relevance of Europe in the 21st century depend on it. Thank you very much.